Let's summarize what we have learned this week in relation to project financing. This week we looked at the evaluation of a project, how it relates to the feasibility of a project, and what we can offer our investor in order to reduce their risk and optimize their profits. Attracting and vetting investors, establishing a project's market feasibility, and designing a solid finance plan are the essential elements to reduce risk and optimize returns. We'll look at our investors' checklist, we look at our project's feasibility, and we will put together a finance plan that includes the most common and most applicable finance sources available to us today. Verifying the market demand for our project is the first step to verifying our project's feasibility. Lining up non-recoupable finance elements in our finance plan is the second step of verifying our project's feasibility. And both those steps will end up reducing our risk and optimizing our profits. Now, what constitutes a commercially viable project today? A packaged film or television project that can cover its production cost through international sales estimates and incentives, as well as being able to cover 30 to 35% of its budget through pre-sales. This means when we put together a finance plan, 70 to 75% should be covered through our estimates for international distribution revenues, and 20 to 25% at minimum should be covered through production incentives that are not repaid. 30 to 35% of our international sales estimates should become actual pre-sales, actual contracts, actual sales made before we produce our film, which is why they're called pre-sales. If we would have produced a film already, they would just be called sales. How are sales estimates established? A sales agent reads the script, reviews the talent package we envision, and provides projections for international sales and distribution revenues based on the script, the genre, and the budget range we are providing to him. These projections are called sales estimates. Sales estimates are just projections. They're not actual sales. Actual sales is what we refer to as the pre-sales or the sales. What are pre-sales and why are they important? Pre-sales are distribution rights sold prior to the delivery of the film, prior to the producing of the film. Pre-sale contracts are usually subject to a 10 to 20% down payment due at execution of the agreement, and the balance is due upon delivery of the film to the buyer or distributor. What that means is our sales agent will do a pre-sale, a distribution sale for our licenses to a distributor in a country, for example, Germany, England, Spain. And each of these distributors will give us a 10 to 20% down payment the very moment they sign the pre-sale agreement. This money will later be available to us to be used in our finance plan to cover our production cost. And the distributor will then pay the balance when our film is finished and when we deliver the film to our distributor. How project elements and estimates help establish an optimal finance plan? Project elements, which include the script, cast, estimates, and pre-sales, are the foundation to fund the production cost and structure a risk-mitigated return of investment scenario by applying a solid finance plan. What that means is our script has to be strong, our cast has to be strong enough to support our sales estimates to meet a 70 to 75% minimum threshold, and allow us to pre-sale at least 30 to 35% of our budget. We will be using these pre-sales to get a bank loan, and all this will help us to put together funding sources to fund our production cost. What constitutes a solid finance plan? A finance plan that has low equity, high incentives, high pre-sales, and a strong senior debt component is a solid finance plan. It reduces the risk for the investor and verifies a market demand for the project. That means the idea here is to keep the equity as low as possible, because it is the equity investment that takes the highest risks. Our job is to shoot in a region where we can achieve a high production incentive, because this finance component we do not have to pay back. Our job also is to make sure that we can establish pre-sales, because those pre-sales establish the market demand for this project. If there is no pre-sale available, that means the market demand is questionable, and this will increase the risk for the project. What are the potential pitfalls of distribution? Sales agreements with sales agents who do not agree to a collection agent or demand a high sales fee and expenses, or a long-term contract without performance clauses are a problem for us. And US theatrical distribution agreements without advances do not allow us any chance of revenues. If we work with a sales agent who will not agree to a collection agent, that means that that sales agent will be receiving all the payments that are made from the distributors. At that point, when the payments from the distributors go to the sales agent, we lose control over our revenues. That is not something that protects our investors, and it's not good for us as the producer. Today, any professional sales agent will agree to a collection agent. Sales agent also should ask for a sales fee that is industry standard. Today's industry standards are anywhere between 15 to 30%. A sales agent should also agree to a performance clause. This performance clause means nothing else than him agreeing to live up to the promise he made with his sales estimates. How to optimize profits? Applying a feasible budget, a solid finance plan, and employing a collection agent helps us avoid all the pitfalls, especially the pitfalls of distribution. Understand the marketplace. Changing financial models, changing economies, and changing demands require constant research of the market trends in order to stay ahead of the curve. Producers today need to view Hollywood as a business, not just as a creative playground. Here are some considerations that need to be made. The story leads the way. Develop a strong, unique story that can sell. Attach strong talent to optimize the value of your project. Understand the audience and your marketplace for the project. Is it an art house movie or is it a mainstream movie? Support the genre that you decide to produce. And understand your buyer and distributor. What does the distributor want today? How much can they pay today? Verify the demand for your project by monitoring pre-sales. Is your project being able to pre-sell anything? Match your budget with your sales estimates. Is your budget too high? Are the sales estimates too low? Define your market and work within that market. Be strong in the marketplace that you want to release your project into. We talked a lot about sales estimates. What you see here is a sales estimate sheet that was published by the Hollywood Reporter a while ago as the Hollywood Reporter Going Rate. It's an international sales estimate sheet. Obviously, these rates are subject to change, and they very much rely on the project you are producing. But what this sales estimate sheet does, it will give you an overview of how much money you can receive from what territory in relation to your budget. So when you see the different budget levels and you see the license fees and their ranges, you can understand the value that your project could have in these varied countries. For a producer to optimize revenues, it is important to understand the distributors, because distributors and buyers are the basis for those revenues. We have to always keep ahead of the curve by being aware of any changing demands and any changing price levels with distributors and in the international territories, the international countries. Distributors are buyers who acquire a distribution license for a project to be released in their own home country, which is also referred to as the licensed territory. And they acquire this license for a set period of time, which is referred to as the term. Such a distribution license is sold to the distributor by the sales agent. The sales agent is the middleman between the producer and the distributor. Demand. Buyers are looking for genres that work in their territory, in their home country. Those are usually mainstream genres, like action, thriller, some drama, and they prefer projects with globally known and established theatrical cast in the leading roles. Price levels. The acquisition pricing for a distribution license reflects the price level value of the territory the distributor is acquiring for. Local economy changes may cause variations in pricing. This means that, for example, in the country of Germany, your picture could be worth 10% of the budget, while in Spain, it's only worth 4% of the budget. Every country, every territory reflects a certain level of pricing for your project. Tier 1 and Tier 2 territories. Tier 1 territories are countries with a stronger economy. For example, Germany, Italy, the UK, France, Spain, Benelux, Canada, Scandinavia, Japan, Australia, etc. Those are our Tier 1 territories, and they reflect about 50% of all the revenues from foreign distribution. And the acquisition prices vary only minimally, which means their value is usually not changing much. That is why sales agents and producers, as well as investors, should focus on selling these territories first. Tier 2 territories. These are countries with a changing economy and a less reliable price structure. Those countries have seemed to include Russia, the Baltics, India, the Middle East, Latin American countries, and parts of Asia. These countries have either a changing economy or they have seen not to pay on time. Banks who are very familiar with the pricing and the payment history of certain distributors will be the ones to apply this Tier 1 and Tier 2 territory ranking. The US territory is defined as North America and can also include Canada depending on the buyer. The US market is very unpredictable, and not every project is acquired by a US distributor. Now, if they buy, the price range is very volatile and can be anywhere from 0 to 100% of the budget. Sometimes it can be even more than the budget. It really very much depends on the project. In many cases, the US territory is sold after a film is finished and has been screened at a film festival or a film market. To sum it up, banking or distribution agreements is an essential element for us to be able to finance a portion of our production cost. Obviously, we established pre-sales are also important to verify the market demand for the project in the marketplace. And pre-sales should be done on a price level that is projected in the sales estimates. Pre-sales are seen as bankable collateral, and the bank will be able to take these pre-sale contracts and cash flow them for us. The bank will apply a Tier 1 or a Tier 2 rating to those contracts, and it depends on what territory, what country the distributor is buying for and who the distributor is. Tier 1 territories are known to be economically strong territories with distributors who have impeccable payment histories. Tier 2 territories are known for countries with an economically challenged economy and maybe with distributors who have a questionable payment history. Understanding the risks when putting together a project is important. Hollywood producers and investors should apply regular startup business techniques when planning and realizing a project. Obviously, our project finance plan should include elements which are focused on reducing risks and optimizing returns. In our case, we need to make sure that our chain of title is clean for the IP, for the script, and for all the underlying rights. As producers and investors, we should insist on a talent package that supports the value proposition that was given to us with sales estimates and pre-sales. We need to understand that our low or take pricing for the international distribution revenues is our base case. We should not be using breakout films as comparison projects for our numbers, because these exclusions are exceptions and they do not represent the rule. Establish parameters that verify market demand for the project by making sure that 30 to 35% pre-sales can be established. The project finance plan should include non-recoupable incentives, free money, that could be tax incentives and other non-recoupable finance elements we will be talking about. We need to verify that the bank will support the sales agent projections and will bank the pre-sales in a way that will help us reduce the risk for the equity. Mitigate the risk for investors by applying a low equity investment amount, ideally not exceeding 35%, will help us and the investor to obtain profits. Establish industry standard deal terms with all parties involved and insist on terms that allow profitability and transparency. That includes hiring a collection agent to manage revenue collections, expense and profit distribution, as well as reporting and accounting. We need to use a completion bond company to ensure the production and the investment and ensure overages that can occur with our budget and our production and potential scheduling issues. When financing and producing a project, and when ensuring revenues to come in and be used as contractually agreed, we need to be sure to avoid any Hollywood creative accounting. Creative accounting is not possible when a collection agent is engaged. Remember, major studios finance their films and manage revenues and expenses in-house. They do not use a third-party collection agent. Professional independent producers do use third-party collection agents to avoid the creative accounting. The collection agent has a very important role. He provides full transparency with collecting of revenues from distribution and will pay back investments and disperse any expenses relating to distributions and other parties who are owed an expense or a repayment. It's a neutral party that collects revenues from all sources in relation to the sale, distribution, and exploitation of all rights in connection with the film and the TV project. The collection agent issues reports of such collections to all parties involved in the production and distribution of a film, as long as they are party to the collection management agreement, also referred to as CAMA. The CAMA combines all the agreements related to a film or television projects. It includes all the terms that are reflective of anything relating to financing, distribution, or expensing, as well as profit payments. When working with investors, producers should have a checklist and investors should have a checklist. We should be doing due diligence on the investor and the investor should be doing due diligence on the producer. We as producers need to fully disclose all the risks that are applicable with the production and financing and distribution of our project. The investor wants to see producers in the team that have a track record of producing a project that is similar to the project we are producing. It is our job to define the value of our project in the marketplace today. It is our job to do due diligence on the director. We need to make sure that we align our interest and risk and reward with the interest and risk and reward of the investor. We should apply a fair investor deal that is industry standard. Investors should include late payment clauses in deals with producers. All milestones and essential elements should always be put in writing. Ideally, the investor agreement should have an arbitration clause. The investor may want to take an active role. If that is the case, it should be comprised in writing. As producers, we should include a completion bond insurance for our project in order to ensure the on-time and on-budget production of a film or television project. We must insist on the funding being spent as we laid it out in the budget, line item by line item. We need to protect revenues and establish a transparent accounting through collection agents. And we need to also protect all our master elements for the film and related distribution elements.